Welcome, students. The next topic of grade 11th accountancy is adjustments in final account. After preparing the trial balance, there are certain particulars or certain things which are remain and they needs to be adjusted. This adjustment is done point wise and how the effect in the final accounts are made we are going to see in this chapter. What is an adjustment? The trial balance is a statement of ledger account balances as on a particular date. In trial balance, those particulars which are remaining or any financial events that happen after the trial balance is prepared or the events which are not related to ledger account balances are considered as adjustments. Final accounting is done towards the end of an accounting period. The trial balance that we consider in a preparation of final accounts is the one that is prepared towards the end of accounting period, that is on the last day of the accounting period. There might be a number of accounting transactions which might not have been taken into consideration by that time. The trial balance has prepared. The transactions which have not been journalized appended to the trial balance are what we call as adjustments. Now, how to deal with adjustments? The example of such adjustments are closing stock, outstanding expenses, depreciation of assets, goods sent on sale or return basis. These adjustments are to be given effect in two sides of final account. One will be debit and another will be credit. And it will have two effects. One may be in balance sheet, another may be in trading and profit and loss account. First, we'll be seeing closing stock. Closing stock is a stock that is at the end of accounting period. It is also called as unsold goods, but it is not always the finished products. It may be stock of raw materials, stock of work in progress, and it should also be deducted from the accounting period's cost in the balance sheet. Adjustment of closing stock is to be prepared as under. It is to be credited to the trading account and it is shown in the asset side of balance sheet. If the closing stock is given in the trial balance, then it should be shown only in the asset side of balance sheet. It means that the purchases already have adjusted the closing stock. Next important adjustment is outstanding expenses. Expenses due but which have not been paid. If it is given as an adjustment, then it must be added with the corresponding expenses and debited in profit and loss account. It should be shown in the liability side of balance sheet. So we have twofold effects. One effect is debited in the profit and loss account, added to the respective expense, and to be shown in the on the liability side of balance sheet. If the outstanding expense is given in the trial balance, then it will be only shown as an asset in the balance sheet. The entry will be expenses account debited to outstanding expense account. Next important adjustment is prepaid expense or unexpired expense. Prepaid expenses are the expenses that benefit of which have not been fully enjoyed at the end of the accounting year. They are expenses which are paid in advance. The adjustment for prepaid expense, if it is given in adjustment, then it must be deducted from the concerned expense in the debit side of profit and loss account. And it is shown in the asset side of balance sheet. If it is given in the trial balance, then it has only one entry or one effect that is shown on the asset side of balance sheet. The journal entry will be prepaid expenses account debited to expenses account. Next important adjustment is outstanding income or accrued income. That means income that is due but not received. Its adjustment will be shown as under. If it is in adjustment, it will be credited in the profit and loss account and added to the respective income. Also, it will be shown as the asset under the asset side of balance sheet. If outstanding income is in the trial balance, then it will be shown in the asset side of the balance sheet. The entry will be accrued income account debited to income account. Income received in advance or unexpired income. This is the next important adjustment where the incomes are received in advance, but the services for that or the goods for that are to be given. That is why it is considered as a liability of the firm. If unexpired income is shown as an adjustment, then it should be deducted from the corresponding income in the profit and loss and shown in the balance sheet liability side. If it is in the trial balance, then it will be shown in the liability side of the balance sheet only. The journal entry will be income account debited to income received in advance account. Next important adjustment is depreciation. Depreciation is a decrease in the value of an asset due to wear and tear, passage of time, obsolescence, etc. Adjustment, if it is given in adjustment, then its amount will be debited to the profit and loss account and should be deducted from relevant asset in the balance sheet. Journal entry will be depreciation account debited to concerned asset account. Bad debts. Any irrecoverable portion of sundry debtors is termed as bad debts. Bad debts is a loss to the business. If it is given in the trial balance, it should be shown on the debit side of profit and loss account. Bad debts given in the adjustment is to be deducted from sundry debtors in balance sheet and same is debited to the profit and loss account. Journal entry for bad debts is bad debts account debited to sundry debtors account. Provisions for doubtful debts. It is a provision created to meet any loss if the debtors fail to pay the whole or a part of the debt is kept by them. It is shown in the debit side of profit and loss account. The other entry is it is deducted from debtors in the balance sheet. Journal entry is profit and loss account debited to provisions for doubtful debts. When the bad debts are given in the trial balance and further debts and provision is given in the adjustment. The bad debts given in the trial balance is debited in the profit and loss account and further bad debts is added with it and the same is deducted from the debtors in the balance sheet. Provision is calculated only after the deduction of further bad debts from the debtors. Provision is debited in the profit and loss account and same amount is deducted in debtors from the, in the balance sheet as counter adjustment. When bad debts and a provision is given in the trial balance and also a new provision is given in the adjustment, this is the type of adjustment where there will be a bad debts table. The bad debts given in the trial balance is debited in the profit and loss account and new provision is added with it. Then the new provision is deducted from the debtors in the balance sheet. The provision given in the trial balance is either deducted from the debtors or it is debited in the profit and loss account. When the bad debts and provision is given in the trial balance and further bad debts, new provision and provision for discount on debtor is given in the trial balance. Here we have three-step solution to this. The bad debts is debited in the profit and loss account, and further bad debts and new provision is added with it. The further bad debt should also be deducted from debtors. New provision is calculated only after deducting the further bad debts from debtors. The new provision is deducted from debtors. Third step, the provision for discount on debtors is calculated after deducting the further bad debts and new provision from the debtors. It should also be deducted from debtors. Provision for discount on debtors. Provision for discount is a provision created to meet any loss due to allowing of discount in the next year. When the debtors of current year make prompt payment, it has the following effects. It is shown in the debit side of profit and loss account. It is deducted from the debtors in the balance sheet. The adjusting entry is profit and loss account debited to provision for discount on debtors. Next important adjustment is journal manager's commission. Journal manager commission is charged on net profit. It has two cases or two chances where journal manager's commission is calculated. Journal manager's commission is calculated on net profit, that is before charging such commission, and commission is calculated on net profit after charging commission. So we have the two categories. First, when it is directly on net profit before charging such commission, to find it, we have to multiply the rate of commission directly on net profit. And when it is after charging such commission, net profit multiplied by rate divided by 100 plus that rate. The treatment for the above mentioned figure, that is, general manager's commission, should be debited to profit and loss account, and as it is not yet paid, it is treated as liability and shown as outstanding expense in the liability side of balance sheet. Next important adjustment is goods distributed as free sample. When the goods are going out from the business, it is always be credited. As per the rule, credit what goes out. So it should be deducted from the purchases in the debit side of trading account, and it should be added to the advertisement expense in the debit side of profit and loss account. So minus from debit is credit, and another effect plus to debit is debit. So both the sides are affected on this type of adjustment. Loss of stock. This is a very rare case that happens in a regular business course. Stock loss due to any accident is termed as loss of stock. It can in, be due to fire, due to any natural calamity, or due to theft. Businessmen most of the times insure the stock, and there are three cases. Sometimes the insurance company gives the partial claim. Second is sometimes the insurance company gives a full claim. And third case is when the stock is not insured. In any of these cases, the total loss of stock is credited to trading account, and actual loss, that is a difference in amount, will be debited to profit and loss account. And if any claim received should be shown in the asset side of balance sheet. If the stock is insured and the insurance company gives the partial claim, total number of amount of goods is credited to the trading account, actual loss, the difference amount, is debited in the profit and loss account and claim is shown in the asset side of balance sheet. If the stock is insured and the insurance company give full claim, total loss of the amount of the goods will be credited to profit and loss account and the amount received as claim should be shown in the asset side of balance sheet. Uninsured stock, total amount of goods which are lost, should be credited to trading account and actual loss, that is the total amount, should be debited to profit and loss account. Next is goods taken by the proprietor for his personal use, so that is drawings. The amount of goods that is taken will be deducted from the purchases in the debit side of trading account and it should be added in the drawings, which will be further deducted from capital in the liability side of balance sheet. Goods sent on sale or return basis. Sale or return basis is an adjustment given to the customer that if the retailer is able to sell the goods, he will sell, and if the sales does not happen, that goods will be returned back to the businessman. Here, the selling price is to be deducted from the sales and debtors, and the cost price should be added to the closing stock. This is a very rare case, and in very rare adjustment, this type of sale or return basis happens. Wages include erection charge of machinery. Erection charge of machinery is a capital expense. So it is not treated as a revenue expense and it should be deducted from the wages in the debit side of trading account. Again, it will be added to the relevant asset account. Here it is machinery account on the asset side of balance sheet. If any depreciation is also given, then it should be deducted from the increased value of asset. That means at the time of calculating depreciation, the erection charges should be added to the value of machinery. Thanks for watching.